In this video, I'm gonna share with you guys a specific entry point that I never shared before. And I'm sure that if you practice this method constantly, this will definitely be an extremely powerful weapon. This video could be one of the best videos that I've ever done. I will explain everything in great detail so that you can easily understand it even if you are a beginner. Now please prepare a pen and paper to take notes and watch the video repeatedly for a more thorough understanding. If you have any questions, feel free to comment below. I will help you answer them. You may know that I wasted many years struggling with the ineffective methods and the complicated indicators. And finally, I've come to realize that in trading, the simpler the better. Minimalism in trading is the key. To begin, we first need to talk about the market structure. You may know before that there are three stages of market. Those are increasing, decreasing, and sideways. But to be more specific, I'm going to divide them into four stages. First, the uptrend structure. Second, the downtrend structure. Third, the regular sideways. And finally, the irregular sideways. An uptrend structure is a sequence of waves that broke the old tops. Similarly, a downtrend structure is a sequence of waves that broke the old bottoms. That is the theory that most of us have been taught. This theory is not wrong. However, there are some moments when the market is dramatically increasing or decreasing. Therefore, we don't need the definitions to be too precise. In this field, there's no theory that is 100% accurate. You should view it with your own eyes and keep it simple. If you see the price line move downwards, it just means that it is downtrend. If it has been going horizontally, it is consolidation. If it moves upwards, it is uptrend. To begin with, we need to simplify everything. Next, I will talk about the regular and irregular sideways stage. The regular sideways structure means that the price travels horizontally but in an equivalent amplitude that is easy to notice. For example, in a rectangle or triangle. We can also see that those regular sideways, like in this area, are the stages in which it goes horizontally within the rectangle amplitude. Or this area is the consolidation within the triangle amplitude. Or here. You may find it difficult to recognize it, since the amplitude is relatively large. However, let's try changing to the day time frame for clearer observation. This is a consolidation within a rectangle. The irregular sideways structure means that the price travels horizontally, but constantly breaks the tops or bottoms and then comes back. There are many ways in this stage. Next, in this area, we can clearly recognize the similar stages. Here or here. Although these stages are still involved in the regular sideways structure of a bigger time frame. Or this stage. We can see that the price has broken through the support level at this point, but then it instantly comes back to break this top. Therefore, no matter if you buy or sell, in this case, you are very likely to encounter a stop loss, especially if you are using a limit order. So the first thing we need to focus on is the stages with clear trends and the regular sideways stage. Regarding the irregular sideways stage, we should stand outside of the market. These stages can be easily recognized with the naked eye, even if you are using non-indicator charts. Maybe you will not get used to it at first, but practice makes perfect. If you have trouble identifying these stages, don't worry, it's totally fine because this is just an overview. We can have a general overview of the market. And now we're going to take a closer look on how to clearly identify an entry point. Step 1. We will identify the potential buy and sell zones in stages of an uptrend market. For example, we will have a trend like this. A market is a competition between the buy side and the sell side, or the bull and the bear. The bull boosts the price up to this point, and then the bear boosts the price back down. Then the bull takes control and pushes the price up. So when there is a breakout wave going upwards, we will have two potential zones to buy, which I call buy zones. One is the starting zone of a wave, and the other is the former top, which has just been broken through. Why are they considered two potential buy zones? In the starting zone of a wave, the price is transformed from decreasing to increasing, and the side taking control is transformed from the bear to the bull. Therefore, the price has been pushed up. So when it comes back to these areas, the bull will have a tendency to keep buying. And how about the former top that the price broke through? The former top is the zone in which the bear takes control. At the point where the price has been broken, the bear has already rushed into the market once. So when the price reaches here, the bear has tendency to rush again. However, the bull finally takes control and pushes the price up. Therefore, at this point, the buy force needs to be so strong that the price has broken through the top. So this is also a potential buy zone. And these two zones will be supported if there are dramatic bullish candlesticks or strong uptrend waves in this area. That is the price momentum or the price force. However, because of those two factors, we have to take notice of a few things. If the price just slightly breaks through and then comes back down again, just like this, should we use this zone as a buy zone? At this moment, we can also see that the bull is weaker, and the bear immediately rushes in and pushes the price back down. Consequently, this area is not a strong buy zone anymore. So this is much more risky to place a buy order at these zones. One more thing, should we place a buy order if the price breaks out too dramatically and then come back to this area? Let's pay attention. When the price dramatically breaks out, but then for some reason, perhaps a strong level, it immediately comes back down to this zone, especially with a massive momentum. This line indicates that the bear is so powerful that it takes control over the bull's previous dramatic uptrend. In this case, this zone is no longer a potential buy zone. That's why we have to use the Fibonacci. When a breakout occurs, if the price comes back down to the zone in which the Fibonacci ratio is 0.5 or 0.618, overlapping the former top, this area is a good buy zone. Because the momentum is not as weakly as this case or as strongly as this case, but at a reasonable rate, this is the suitable moment to use the Fibonacci effectively. We cannot use it anytime we like. Fibonacci doesn't indicate the supply-demand factor. However, it does indicate the balance between the waves. Therefore, when Fibonacci overlaps this zone, this is a really good buy zone for us to place a buy order. It doesn't mean that you apply everything mechanically. It will only help us tell the difference between the better and the worse buy zones. And to have a good entry point, we need more than one such factor. Similarly, the downtrend is the contrasting case of the uptrend. We can also apply this theory to identify a good sell zone. Regarding the regular sideways, for example, price travels within a rectangular or triangular amplitude, we can identify the buy or the sell zone, which is at the two sides of the rectangle or triangle, especially when the price breaks through the zones and then comes back to these zones. So we have identified what is an effective buy zone and sell zone in different cases. Step 2. We need to identify the signal to place an order. In an uptrend, after identifying a potential buy zone, a good entry signal is a signal that indicates the exhaustion of the bear and the control of the bull. Identifying the entry signals is also crucial, because it's extremely risky if you only place a limit order at the levels. There are three cases when the price reaches a buy zone. First, it reaches the buy zone and then moves in the reverse direction. Second, it slightly passes the level and then moves in the reverse direction. We often call that false breakout. And third, keeps going down without changing the direction. So among those three cases, if we immediately place the order and don't wait for a signal, there are up to 2 cases in which we encounter stop loss. That's the reason why it's important to wait for a clear entry signal at the level. There are 3 stages to identify a buy signal. In the first stage, the sell force is gradually diminishing. Regarding the candlestick pattern, this is demonstrated by the long wick candlesticks. Or regarding the waves, the smaller the time frame is, the more green candlesticks emerge. The price momentum is no longer steep, but gradually descending. The second stage is the conflict stage between the bull and the bear. In terms of candlesticks, it might be some short candlesticks with small and indistinct bodies. So at this stage, it will be more distinct if there are 2 or more candlesticks. In a smaller time frame, it could be a stage in which the price travels horizontally. The third stage is the confirmation of the trend continuation. After the conflict stage, a strong uptrend candlestick with a long body emerged. It breaks through the previous conflict stage. Now we will go through a few examples on both cases in which we place the order and which we don't. This error, which we just analyzed, is also an entry point. As you can see, although previously this wave didn't break through this top, we can consider the bottom a buy zone. Because first, the uptrend momentum here is very strong. And second, the major trend is also a clear uptrend. We can see it here. So firstly, I will place an order here. We don't see any resistance on the left, so for now, let's just place a specific take profit ratio. For example, I will place it at 3R. Then we will continue to observe the price progression. Let's take a close look at this error. In this case, we can also see that this zone is not a strong buy zone, although the price has just broken out earlier. It's similar to the case in which the price breaks through the former top, but the force is pretty weak. So in this case, our potential buy zone is this zone. At this point, we can clearly recognize the entry signal. First, the buy force is diminishing, which is demonstrated by the candlestick with long lower wick. Second, the conflict stage occurs. It can be clearly seen at among these 3 candlesticks. These 2 have long upper and lower wicks. And all 3 candlesticks have really short bodies and oscillate within this consolidation. This is the confirmation of trend continuation. It is confirmed by this candlestick which breaks through this zone. Therefore, to those who haven't entered at this point, here is also the next entry point for you to enter. Now let's see the move. This zone may be our buy zone. However, we can see that these candlesticks show the stage that the force of the bull is diminishing, and the conflict stage between the bull and the bear. But there is a lack of confirmation of the trend continuation, which is demonstrated by a candlestick indicating the strength of the bull. Therefore, we cannot place an order here. We already had a buy zone here, and this whole area is the zone of stage 1 and stage 2. That means the diminishing force and the conflict stage between buy and sell are demonstrated in this zone. Afterwards, among these two candlesticks, the confirmation of trend continuation is demonstrated by a breakout in this zone. So this is also an entry point. After that, the price rises sharply and breaks through all our take profit zones. We can also see that this is also a buy zone. However, this zone lacks the second stage, which is the conflict stage between buy and sell. It only demonstrates the diminishing force of the bear and demonstrates the third stage, which is the confirmation of the strong buy force. And at this point, we can also place the order when these two candlesticks emerge, and the stop loss is down here. We have a case like this. Firstly, let's have an overview to determine which stage this is. As we can see, this stage is the sideways stage. And this is an irregular stage. We can see that it breaks out here, here, and here. And they are all going down after the breakouts. So in this case, at least we should wait for the price to break through these two zones. In order to form a distinct downtrend or uptrend. And before that, we can also see in this zone, it will prioritize the downtrend more and move horizontally afterwards. Now, let's see the move again. It can be seen that in this area, the price breaks through all these zones, and also this. And just like we expected, we can wait for a sell order in this zone. These will be our potential sell zones, or this. And furthermore, its downward momentum is extremely strong. However, the most important thing is that we will wait for the signals in this area. In these cases, we can see that the price still reacts, but it doesn't have enough stages to form a signal. Therefore, we will not enter again at this point. This zone is also the same. Although there is a strong bearish candlestick, this is within the zone which the bull can hold back. So we cannot take risks and enter right away at this point. However, when the price reaches this zone, the first factor, which is the diminishing sell force, occurs. And the second stage is the conflict stage between the bull and the bear. We can see that the conflict stage in this area. And the third stage is the confirmation stage. It is confirmed by this candlestick. Therefore, we can place a sell order here. For the meantime, we place the take profit order in this zone with the ratio being 2R. And in this case, we can see that the bull cannot hold back this zone. This zone is broken. It's different from this case in which the bull still manages to sustain. However, in this case, the bull cannot sustain, and if it tended to keep going up, it would break through this top for a second time when reaching this zone. In that case, we will just stand outside and not place any order. However, in fact, our signal has occurred in this zone, so we will place the order here. and then we continue to observe the progression of the price. At this point, it has broken through this area. It then reaches this zone, but it still doesn't make an uptrend back. Subsequently, it sharply declines and broken through all these zones, and the downward momentum is very strong. Therefore, in this case, we can move stop loss to entry above this stop. This is a set point to place stop loss if we want to hold on to be able to take profit at this point. Or we can simply place stop loss at this point, since the price has already exceeded 1 hour. One more thing to notice is that in some cases, the price hasn't headed to the take profit zone, but the momentum still declines. In this area, it has tried to break down once, but it cannot do it the second time. So we should close the order in this area. So we can place here when the price is close to our take profit area. And the take profit area is actually in this zone. The very first candlestick with a different color, after a decreasing wave. Okay, now we will continue to let the price run. In this period, we can see that it has formed an uptrend. If we have not placed the take profit order yet, maybe we should take action at this point. At this stage, we can see that the price is still in the sideways zone. However, it will prioritize the uptrend tendency. You can see that the price breaks down here, tests again and pushes up. But this area is not a good spot to place the order. It's actually a zone where we can wait to buy. This area also doesn't give any signals, and our buy zone it can move up here. At this point, it appears to have two stages. The first stage where the momentum gradually descends, and the second stage is where the conflict between the bull and the bear occurs because of these two candlesticks. Now we're going to wait for the third stage. It's the confirmation of trend continuation. If the third stage doesn't show up, we shouldn't place any orders in this area. This is the confirmation candlestick, thus we have all the three necessary stages to place the order at this point. In this case, this area is also a resistance zone. However, if we place the take profit order here, the RR ratio won't be good. So we hope that it will cross this zone and go up here to this area. And in the case it reaches this zone and doesn't break through, I will read these candlesticks and quit shortly afterward. Now let's see the price run. So after about 3 candlesticks, it has matched our take profit order. Those are some examples of when we should place orders as well as when we shouldn't. In the end of this video, I also have something to tell. Almost every trader in the market always wants to have orders every day. Because of the desire to earn money, they believe that only by placing many orders that they can make profits. But in fact, the professional traders only wait for the most suitable moment. They wait until the market has a clear structure, and then they wait for a good signal to enter, which matches their rules. They look for the reason not to place orders rather than the reasons to do so. And even if there is only one reason that doesn't support them, professional traders prefer to stand outside and not risk their money. When you have a big value of 1 R, you will understand this. You might be prepared to risk if the R value is low, but with a high value, your mentality will be completely different. You will definitely have to be more cautious. And one of the most important points is that you need to backtest many times to get used to the methods and place the orders reasonably. Secondly, you have to manage your capital on every order you place. And the third thing is that you need to be patient and follow the rules. If you find this video helpful, give me a like and a subscribe to this channel to stay up to date with my latest video. Goodbye and hope to see you in the next videos.